Hello, this is Kirk Spano with Investing 2020s, and this week I was at the largest shale event of 2024, Super Dug by Hart Energy in Fort Worth, Texas. I am at the Hampton Inn. Very nice. I recommend it. If you have to stay near the convention center, I will say that downtown Fort Worth is very sleepy. And I saw the tallest building in the city, 40 stories. They got bought back by the bank last week for about $12.5 million. You can find that article on Bloomberg and probably other places. Just goes to show that we're pretty early in the transition on real estate. So I thought I'd talk a little macro, and there's an article on Bloomberg right now, and it's from a Wall Street Week interview with Rick Reeder over at BlackRock. And does this sound familiar to you? Rick Ryder says that cuts, not a hike, are more likely to tame U.S. inflation. And he talked about housing and a couple of other things, the spreads in the bond market, how we are transitioning to being even more service oriented, even though we're reshoring industry and we are seeing disinflation in goods. So there's a balance to be found. He really made the case for the eventual cutting of rates and made it sound like it was sooner than later. And he talked about the US Treasury market and how lower rates are basically required, which is a topic that we've covered over and over again for about a year. And that eventually we're going to see massive quantitative easing, at least during the period when we're at peak baby boomer retirement. So that could start anywhere between 2026 and the early 2030s. At some point, we're going to see a massive expansion of the Federal Reserve balance sheet in order to float for 5 to 10 years the baby boomer retirement financing. And then over a generation, we'll pay that off. So I wanted you to really take a look at this article. And as I've always said, or I've been saying for the last couple of years, make sure you're reading your Bloomberg and get the interviews online, whether it's YouTube or through an app. But Wall Street Week this week is a must watch. There's two guys on there, Reader, and I forget the private equity guy's name, but they really talk about a lot of the topics that we have covered, over the last year. Most of what we are doing is right. I think there's a little bit of tweaking to be done, and we'll get to that here over the next several weeks. But the small cap argument that I've been making absolutely seems spot on. The energy transition argument that I've been making seems it seems like there's probably a pretty good opportunity in natural gas that is developing right now as natural gas bottoms over the next month or so, and then probably starts to head up into the summer. So whether we're running a marathon or building a fortress, we're probably doing the right things. So one of the speakers was the Apache CEO, and he talked about the technology that's going on in the Permian Basin. It was very interesting to see that he really believes that the innovation in the Permian Basin will keep it growing for a while, but there's a lot of challenges. And that woman there, actually, I had lunch with her. She's the editor for Hart Energy. The problem that we're seeing in the Permian is that it looks like it's going to peak out in the next 5 to 7 years. And the Permian is really the only basin that's still growing. So there's going to be major pressure on oil prices to rise 5, 6, 7 years from now. If we don't adopt EVs by the end of the decade, if we're not selling a lot of EVs by the end of the decade, oil prices will be sky high in the 2030s. So there is a lot of what I detected, especially this guy from Raymond James, but then there's a couple of other shills in particular. Out of the 30 or so speakers that I got to see, only about three of them were hardcore oil and gas shills. The people that put out those trader narratives about the Biden administration hates oil and gas, even though, he gave them huge incentives in the Inflation Reduction Act, and they're at, an all-time record high production. He hates them. So the vast majority of the speakers took a more balanced approach. They made the point that, look, we're at record production, but the oil is getting harder to get to. If you understand how shale works, there are multiple layers of shale, and you have to drill at each level, and you have to try to make sure that your wells don't interfere with each other. It's called communicating, the parent-child relationship, they call it. The oil is just getting tougher to get. And for the next 5 to 7 years, there should still be some growth in the Permian, but as I'll show in a second, most of the other basins are already leveling out or turning over. Carbon dioxide is going to be able to be used for 5 to 10 years to keep supply kind of level because they will refrac and they will also use carbon dioxide to get more oil and gas out of the ground. The gas really isn't a problem, it's the oil. So we are seeing the end game for oil supply growth playing out right before us. The private equity guys all targeted 5 to 7 years, like five of them. And I had the opportunity to network with some of them. They had networking breaks throughout the day on Wednesday and Thursday. And then Friday morning, I went over and I never didn't even go into any sessions. I just grabbed people to talk to. But it looks like oil production growth in the United States will level off sometime this decade. Uh, Probably 27, 28 is what it looks like. Technology can bump it up just a little bit, but there hasn't been a new major oil basin discovered in the last 10 years. So that is a point that they made is they've looked and looked and looked, and there's a little oil in Michigan and a little oil here and a little oil there. And there's a lot of gas out there. So they're not too worried about natural gas. The Marcellus will just continue to grow in Pennsylvania and West Virginia. I believe that might be the Utica down there. But the Marcellus, Utica in West Virginia and Pennsylvania and that general region, a little bit of New York, those will grow with the associated natural gas from oil drilling dissipate in the 2030s. So we just really don't have a lot of problems with the natural gas outlook for the next 30 to 50 years. Who knows after that? Who cares? We'll all be gone. Or, well, I guess some of my younger viewers won't be gone, but if I make it 50 years, that means that I've been eating a lot of salad. Let's go through some more of this here. Apache CEO pointed out that they're using lots of innovative technology, different types of fracks. The laterals, the sideways frac, the laterals are all pretty much 2 miles, moving to 3 miles. Some of the operators are experimenting with 4 mile long fracks underneath the ground. I mean, 4 miles. I mean, just imagine that. And they drill them at a little bit of an angle, so they hit different strata within the oil shale. It was, technically pretty interesting. Some of them were connecting their fracks from, that they were running in parallel, and now they're kind of making a U shape. There's a lot of creative things out there, and it depends on the geology of the shale. So in the Permian, you have pretty easy shale geology. But when you go to Oklahoma, it's a very tough shale, and you got to talk to one of the higher ups. I forget which executive it was. It wasn't Harold Hamm, but it was one of the executives at Continental Resources, which got taken private, and that's a theme. A lot of the oil companies, I think, one of two things will happen, and this is what the private equity guys were talking about, the deals that they were working on, and they talked about the multiples that they did them at, was that there's not many private companies of scale left. There's still 500 or 600 small shale producers in the Permian, but you're talking about a rancher who has, 5 wells or 10 wells. You really have 10 producers, and I have that chart somewhere that I'll put up in an article. Really 10 producers, 5 really big ones, and then you got, 5 that are mid-size. I think I did post that chart in chat. But the really big guys, which are Exxon, Occidental, Chevron, EOG, and I'm missing one. They really aren't going to be allowed to get bigger by the Justice Department. So that was actually a topic, was how they're dealing with the Justice Department, which is trying to prevent an oligopoly of two in the U.S. oil space. Right now, Exxon and Chevron account for 27% of all U.S. oil production. 20 years ago, that was 6%. So you can see that how the consolidation has worked out. So we are definitely developing an oligopoly. The Justice Department, which Lena Khan gets villainized by several of these people at the conference. And again, there's like three people who were like super shills, and they really just wanted to demonize anybody who wasn't like a cheerleader for oil and gas. And again, the other 90% of the people there, they took a balanced approach. And I think that what you're going to see is more mergers than takeovers from this point. So your mid-sized producers, your Permian Resources, companies like that, they are very likely to merge with somebody. They will continue to have bolt-on acquisitions of the really little acreages. So like they'll go out and buy a ranch or whatever they find to get 5 or 10 more wells. But really what it is they want to create contiguous areas so they can do those longer laterals because the economics of only doing one frac and making it longer versus doing two fracs is actually a better deal for them. So you're going to see probably the top 10 to 12 producers acquiring the super little guys, and then you're going to see several of them merge. Apache, Devon Energy, Permian Resources. There's a list that I have, and you'll see probably 7 or 8 very, oh, Conoco was the other one. 7 or 8 very big companies left in U.S. oil, in the next 5 to 10 years. So we are not going to have the number of companies that we had in the past. And all these small ranchers, they really don't have a choice anymore. All these guys with 40 or 60 or 80 or 160 or 200 or 300 acres, they either cut a deal or they get put out of business actually by the methane restrictions. And that is one of the things that's going on is the methane restrictions require data collection and and being able to monitor your methane. So the methane rules are forcing a consolidation in the space because the smallest guys, your rancher that has 5 or 10 or 20 wells or whatever he has on his land, he can't afford the technology to monitor as well. So either he has to close them or he has to sell them or he has to, pay to maintain them or pay a penalty. And the methane penalty tax, which just went into effect, is pretty steep. So that was one of the big topics is that they're very afraid of the methane rules. However, an industry has emerged monitoring methane using AI and using satellite technology, but also boots on the ground. So that was a pretty interesting conversation. And again, what it's doing is it's forcing the super little guys out of business or to be merged or bought or whatever. But everything is leading to like 10-ish companies that could produce the majority of oil and by extension gas in the United States because a lot of them will be big gas producers. You have your pure play gas producers as well, especially out east in the Marcellus and Utica. Your what was it, AR Resources, companies like that. So, you take a look, or Chesapeake, you take a look at what's going on, and yeah, we're developing an oligopoly system in energy, way more than it ever was. And, people complained about the way it was, but it's way beyond that now and heading more. So the Justice Department is trying to manage that in a way where we don't all get screwed. But the big thing is if we don't switch to EVs and flatten out our oil demand and really lower our oil demand, because we'll be doing it ahead of much of the rest of the world. If we don't lower our oil demand by the end of this decade, we're going to have really, really high oil prices in the 2030s. Saudi Arabia is going to get their 120, 130, $140 a barrel, which is seeming to be the high side right now. One of the speakers, and I'll focus on the short term here, is move away from the long term, and then we'll get back into it. Mike Morrell was one of the speakers. So I don't know if you recognize this guy from this picture, but remember on 9/11, the guy that whispered into George W. Bush's ear when he was at the grade school, telling him that we were getting attacked? That was this guy. So this guy did an assessment of security and risks in the world right now, and he concluded that the world was more dangerous today than 20 years ago. And he focused on three key things. The first key thing he focused on was Russia. He said Russia, if they win in the Ukraine, that they'll continue to go on. and eventually they'll bump heads with NATO, and then you don't know what happens then. So keeping Russia from taking over, keeping Putin from taking over Ukraine is actually at the top of his list for avoiding major war issues and energy disruption because, of course, Russia is a huge producer of oil. Second on his list was China, and he had a whole litany of things with them. He thinks there's a deal to be cut, but he's not sure if Xi is willing to cut it, which is pretty much exactly what I've been saying. There's a deal to be cut with China. It's just a matter of, are the communists willing to cut a deal, or are they just going to be, pound the table, we're in charge sort of thing. So everything China's doing is to have a greater role in influencing other countries so that when the leader of a small country wakes up, their first question isn't what does the United States want, but what does China want? And he walked through that pretty step by step. Again, he doesn't think there's any chance for a deal with Russia. We just have to beat them. But China, he was hopeful that there could be a deal. And then the third thing was terrorism. And this is where it got scary. So he says this isn't the highest likelihood of things to happen. He put it at about 20% likely, was that there would be a terrorist attack in the United States sooner than later, and that the war in the Middle East would get broader. One of the things he said is most Americans, if there was a terrorist attack tomorrow, would be surprised. He said, I wouldn't. So he cited security on the border, but he really just cited everything that Iran does around the world as being a problem. Having people that have been in the country for years and years and years already is really, the sleeper cells is really what he was concerned about. So he said anybody who puts the handcuffs on the FBI is just putting us at risk. So again, here's the thing. You know that Donald Trump is talking about handcuffing the FBI. That's a bad idea because they're the ones keeping an eye on, the bad guys that are in the country. He was concerned that if Israel attacks Hezbollah in Lebanon, which he believes they will do, that they go more than about a mile inland. So the concern is that Netanyahu chases Hezbollah into Lebanon versus just creating kind of a border zone, that there's kind of a way of allowing Israeli settlers to go back into the Israeli territories and settlements that are closer to the Lebanon border. That he's basically saying, if they create about a 1 mile strip along the Lebanon border on the Lebanon side, that could provide security for the people in Israel. And there were pretty deep discussions in the side interviews because what they would do is give a presentation, then go off to the side on the red carpet area. Morrell didn't do that, but a couple other people with similar credentials well, this guy was associate director of the CIA twice, so or acting director of the CIA twice, and so nobody was really his credentials, but other people who had some macro chops talked about those things. So in the very short term, we have the risk of oil jumping off if the war in the Middle East expands. As you know, we are in the process of cutting a security deal with Saudi Arabia, which probably comes with more oil production starting next month or the month after. So as long as that war doesn't disrupt a lot of things, we're probably in good shape. Now, one of the interesting things here is that if that war expands and we could protect Saudi Arabia, Qatar, and UAE, but Iran gets hit, most of the Iranian production goes to China. So I think there's a tactical approach that they're probably looking at where maybe they kind of want some of that war to expand just so they can hit Iran, which in turn hits China, which puts pressure on China to cut the deal. So there's a lot of moving parts. They all kind of ended in oil prices going higher, though. Natural gas also was one of the things that they talked about, and they think that the price of natural gas in the twos right now is unsustainable. So natural gas prices will go higher. They're talking about the fours in the short term, but ultimately natural gas has to get up to in that 6 to 8 region, and then that'll be very good for the natural gas companies. There is a major impetus to sell liquefied natural gas, and I think the administration. The reason they put some of the LNG development on hold, and they haven't stopped anything, mean, let's understand what the administration did is they paused the reviews for future projects that weren't going to get built for 2 to 4 years anyway. So they're 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 basically creating pressure to cut better deals internationally, whereby it wouldn't be LNG to supplement what they're doing, but rather LNG to replace coal. So the administration really wants to see LNG getting sold out of the United States because that's good for us financially and economically, but they want it to actually replace coal. So they want stipulations internationally that, hey, if you we're going to sell you natural gas, stop building coal power plants. And that's really what is behind that. Oil and gas industry doesn't care. They just want to sell, sell, sell. This whole true patriot thing. I kind of laughed about a couple times because a couple guys used, a couple of shills used the word patriot, and I was like, you're so full of shit. It's all about the money. Because if you were a true patriot, you would understand that climate change is real, and if we can put pressure on other countries to use less coal to help the climate, that's good for us. And by the way, here's your natural gas. Thanks for the money. So, it really it was interesting. The balanced guys tended to be the private equity guys. The Raymond James analyst was a shill. One of the editors at Hart's is a shill. And there's a couple of other ones that, they're just American Enterprise, Institute shills, basically bought and paid for by Koch Industries. One guy, I mean, even cited Koch Industries. So it was pretty interesting who the trader narrative, who the narrative creators were that somehow, hey, Biden administration hates oil and gas because they gave us money and we're at record production. Do you see how those two things they don't go together? So, it is what it is. This guy at Rystad actually was a fantastic speaker, Matthew Bernstein. I am going to get his slides. He offered them, and I think I'm going to interview this guy. If he can give me a couple hours, I'm going to interview this guy. He really talked about how scale is the next thing in shale. So that goes to the whole idea of mergers. There just isn't a lot to be taken over and bought anymore. So you're going to see mergers instead. The the result is the consolidation frenzy that I talked about earlier. So to build scale, you do mergers. Some of these guys, I tell you what, they're so hooked up. Which guy did I grab? I grabbed this guy. I tried to get this guy. This guy was real smart too. And this guy too, but he ran away quick and hung out with this guy. So these two guys hung out together. They're actually friends. Yeah, so the consolidation is going to keep going on, and it's going to play out the way that I said, because of the way the regulations are forcing the tiniest guys to they have to sell or cap. They don't want the biggest five players to buy anything else, and that means that the next say 10 could become five. That's kind of how it'll work out. So 10 to 12 major players down the road. We'll see how it goes. So if you own Apache, you own Devon, if you or Permian Resources, which I own, expect a merger. And those mergers end up creating contiguous drilling acreage, which is more economic than having to spread it around, as I mentioned a minute ago. Yeah, and then they cut a couple heads. But I will say they talked about rig counts, and amateurs and retail investors still follow rig counts. Like, oh look, rig counts went down. That means we're going to have less oil. No, these rigs are literally twice as efficient as they were 5 to 10 years ago. So we just don't need as many rigs. That's what it comes down to. Is technology has made the rigs so efficient now that you don't need peak rigs anymore to maintain peak oil supply. So that is something to keep in mind. So this last phase of consolidation will happen over the next several years, and then that'll be it. And then we'll be in the run out phase for oil over 20, 30 years. Production will be stable for a while, then it'll turn over slowly until it collapses, middle of the century sometime. So if you haven't taken a look at the EIA website, you should do that. I think that this is somewhere where you can get a lot of great information. They have really everything that you could possibly need to truly understand where U.S. oil and gas is. There was one anomaly. There was a one-time adjustment to how they calculated oil production, and you see a big spike. and then it came down. You should really smooth that out and to really understand it. So there is the way the data was collected caused some sharper lines there should be. So smooth that out. It didn't really move up and down that much. But this is what I'll finish with today. You have to understand that oil supply is starting to level out everywhere in the country. So all of the basins are flattening out, even the Permian. So if you take a look at the different Permian colors, let's start with the Bakken though. So the Bakken is the one that I went out to a long time ago. The Bakken is still a major producer. If you take a look at the last year, you can see that it didn't go up. All right. And then these sharp moves are the ones that I'm talking about probably were due to data collection. So imagine that the line is just straight. So for about the last year, production has been about the same, and maybe it drifts up a little bit more for a year or two or three, but then it goes sideways before it drifts down. So we're basically at peak oil production in the United States. Some of these basins are already starting to turn over, but they're smaller. So this is part of the Permian. This is part of the Permian. This is the Eagleford. You see that line right there, that V shape? That didn't really happen. You gotta smooth it out, and that's really what happened. And that's explained by the inventories rising. So even though it looks like production went down, inventories told a different story. Inventories went higher, so that means that you kind of make a dotted line here and fill that in. That's probably what happened. Somebody will correct it in a thesis somewhere at some point. But yeah, it really wasn't that sharp. I mean, it wasn't. I mean, and this probably wasn't quite. Well, this was COVID, so that happened, and then this was. I don't remember what happened in 2000. Was that COVID right there? No, so that's COVID, and then this probably threw that one out too. So this one's COVID. That's not a big deal. So now we're past the production that we had in 2019, uh, but we're close to peak. Again, that means that as the rest of the world is using more oil because they're using cars, because they're reaching the middle class, because they're not replacing as fast as the West. If you are on the slow side of EV adoption, your oil and expenses are going to go up. If you're on the faster side of EV adoption, your oil expenses will go down. So it's really a pretty straightforward relationship. Private equity guys talked about this, and they didn't really build it into their presentations. They just kind of hinted at it. But the private equity guys are clearly getting into clean energy and hydrogen. So, we have some companies that play into those biofuel and hydrogen and liquefied natural gas themes. They did talk about the pipeline a little bit in the Permian. And, there's a couple of major connections coming on later this year. And then they have the gathering networks that have already largely been built out. After those are done, there's just not a lot left to do for collection in the Permian. There's little add-ons and hooking up pipes that exist together, things like that. You're probably not going to see but two or three more significant oil pipeline projects in Texas. And if you see two or three around the rest of the whole country in the next 5 years, that'd be a lot. So you really should expect more than things for those in the significant pipelines in the country. The rest of this decade. It'll be interesting to me to see what Trump says about the Keystone pipeline. I think that there is a reason to consider revisiting that just for the heavy oil that Canada has. If they can figure out a way, and the company, that was involved was just a shit company. They just a crappy safety record. You did not want to have them go over the United States' biggest aquifer. Oh, one of the COOs met him at the baseball game last night. I was sitting in front of him. I was talking to my cousin about what I had done this week. And the guy taps me on the shoulder. He goes, "Are you from West Texas?" And I go, "No, I'm from Milwaukee." "How do you know all this stuff about the oil industry?" I said, "Well, I've been an analyst for a long time, coming and going, and been up in the Bakken, and I've seen all the oil plays except for the Rockies." And anyway, he lived outside of Austin, and his company, he's the COO of a company that builds a lot of the parts for the oil and gas industry. And he didn't come to this conference. Well, I said, "Were you at the conference?" "No, I just came here for the baseball game." And I told him what the guys had been saying. He goes, yeah, that plays into what I'm seeing. And I said, do you have boomers that still work for you? He goes, yeah. And I said, then they're going to retire. Yep. So, maybe you have 20 years of work left. You're just not going to replace your employees as they retire. He goes, we actually kind of thought about that. We're just going to slowly shrink it, but we'll be fine at the end if the company will be gone in 20 years. Yeah, that's the run of the industry. So maybe it ends up being a real small stock at some point and not going all the way up the business. But, anyway, and this guy was only, late 30s, 40, right in there. His whole group looked like they were about 40. One of the things he said, though, is that a mile away from his house, outside of Boston, he was on the west side of Boston, close to the Permian. He said that a mile from his house, people had chemicals and gas and oil in their drinking water. I said, has it happened to you yet? He goes, it hasn't. And I said, well, I hope it doesn't because the government response is really slow on that stuff. And in Texas, they don't really want to talk about it. He goes, I know. And I said, those people in Peoria, it took them years to get water. And he goes, I know. So without saying as much, it seemed like he was thinking of moving to the other side of Austin. So, there really is a problem, he said, with some of the safety on these wells. So I think that there's very much the potential for a negative surprise, right? Like a news event of bad water somewhere, right? Where, 60 Minutes goes in there or somebody goes in there, investigative journalists, and they find more bad water near the oil and gas. So keep that in mind. That is the reason why we really need to be getting more into the alternatives, whether that's LNG, whether that's hydrogen, whether that's solar, whether that's batteries. All of those things are coming. The trader narrative is that they're not. The private equity guys are saying that it is. So you can believe the little traders in their little trading rooms that are fed ideas by hedge funds who are just talking their book and trying to manipulate a trade, or you can trust the guys that handle billions of dollars in capital. You pick. All right. Any questions in particular before I pack my computer up and go down and meet my cousin to go have lunch at the stockyards before I jump on my airplane? Oh, Q&A. All right. All right, everybody. I will have a series of oil and gas articles over the next month before I go to the World Series of Poker. Be a very energy intensive month because I do think that that's where there's a lot of opportunities to run marathons with companies that have a newly owned half a gigawatt of power production, good places to build new fortresses, and the god Amides, all the wisdom of Amidas uh, be with you. All right, everybody, have a great weekend, and I will get this posted tomorrow, and I'm back in.